It's funny to think that a huge corporation and a tiny corner store actually speak the same language. They do. And it's not English or Spanish or anything like that. It's the language of accounting. It's how they tell their most important stories. Stories of success, failure, and absolutely everything in between.
So let's just jump right in. Beyond just having some cash in the bank, how does a business actually know if it's doing well? How does it keep score? Well, the answer is all about mastering this universal language. It's really the only way to get a true picture of what's going on.
And get this modern language isn't modern at all, not even close. It actually goes all the way back to the Italian Renaissance. Yeah, in 1494, a Franciscan friar and mathematician named Luca Pacioli wrote down the system that merchants in Venice were using. His work basically laid the foundation for everything, which is why they call him the father of accounting. Pretty cool, huh?
And this really isn't just some clever saying. Think about it for a second. Every cup of coffee sold, every bill paid to a supplier, every single paycheck, each one is just a tiny little piece of data. Accounting is the system that grabs all those pieces and weaves them together into a story that makes sense, answering that one huge question: are we actually making money?
Okay, so how does this 500-year-old language really work? Let's pull back the curtain a bit and see how it takes all that messy, raw data and turns it into information that a business can actually use.
Every language has grammar, right? A set of rules that gives it structure. Well, in accounting, the grammar is a process that turns the chaos of daily business actions into clear, organized financial insights. It starts with recording. You have to log everything that happens, every single transaction. Then you classify them, putting sales with other sales, expenses with other expenses. After that, you summarize it all into these key financial reports. But the numbers alone don't tell you much. The real magic is in the analysis, where you figure out what it all means. And finally, you communicate that story to the people who need to make the big decisions.
So, who are these people? Who's the audience for these financial stories? Turns out there are two very different groups, and they're listening for completely different reasons.
On one side, you've got your internal users, the managers, the owners, the people on the inside. They're using this info to steer the ship day to day. But on the other side, you have external users. These are the investors trying to decide if they should buy stock, or the banks deciding whether to give a loan, or even the government making sure the right taxes are paid. They're all using the same reports to make decisions from the outside looking in.
And this visual just nails it. The company is right there in the middle, at the hub. And it uses the language of accounting to talk to everybody who has a stake in its success, from the CEO down the hall to some potential investor halfway across the globe.
All right, just like any language, this one is built on a few core words. For accounting, there are really just 3 you absolutely have to know. If you can get these down, you've basically mastered the fundamentals. Let's break them down.
First up, assets. This is super simple. It's all the valuable stuff the company owns. We're talking about cash, buildings, the computers on the desks, the inventory in the warehouse, anything at all that can be used to make money in the future.
Next, liabilities. This is pretty much the exact opposite. It's everything the company owes to other people. Think about bank loans, money you owe your suppliers, any bills that are due. These are the company's financial responsibilities.
And finally, owner's equity. Now this sounds a little complicated, but it's not. Just imagine you took everything the company owns, all its assets, and you paid off everything it owes, all its liabilities. The money that would be left over, that's the owner's equity. It's the owner's actual stake in the company.
So, we have the words now, but how do we put them together? Well, it all comes down to one simple, incredibly elegant, and totally unbreakable rule that makes sure this language always tells the truth. And here it is, the golden rule of accounting. Assets equals liabilities plus owner's equity. It just means that everything a company owns, its assets, had to be paid for somehow. It was either bought with money the company owes, liabilities, or with money the owner put in, equity. That's it. These two sides of the equation must always be in balance, no exceptions.
So, how on earth does it always stay balanced? It's because of a really brilliant mechanism called the double entry system. And the core idea is that for any transaction, you can't just do one thing. Every single business event has 2 equal and opposite effects.
We call these two sides debit and credit. Now, forget everything you think you know from your bank statement. At its heart, it's just this. Something is received and something is given. A debit records what's received, a credit records what's given. So if you buy a computer, you receive an asset. To get it, you have to give away cash. It's a perfect two-way street every single time.
By recording both sides of every single transaction, the whole system stays perfectly in balance all the time. The total of all your debits will always equal the total of all your credits. It's not a suggestion, it's a mathematical certainty. And that perfect self-balancing feature is exactly what makes accounting such a reliable and trustworthy language.
So you see, accounting isn't just for massive companies. It's a really powerful way of thinking about any financial story, including your own. What you own equals what you owe plus your own net worth. It's true for you, too. Thinking in this balanced way can honestly change everything. So what story is your balance sheet telling you?